The Federal Reserve doesn't send press releases when it's worried. It sends silence, followed by decisions markets aren't ready for. Right now, three assets that almost never move together, Bitcoin, gold, and silver, are flashing the same warning at the same time. And the last time that happened, it came right before a shock that caught most investors completely off guard. Yesterday, we followed gold's quiet rebellion against a financial system built on confidence. Gold doesn't chase headlines the way stocks do. It moves ahead of them, sensing shifts in trust before the data ever catches up. We trace that signal back to its source. Government debt, piling up faster than economies, can grow into it. Central banks trapped between fighting inflation and protecting fragile, over-leveraged systems. Reserve managers in country after country quietly shifting away from paper promises and into something no government can print or default on. None of that pointed to a single event. It pointed to a pattern, the kind that has preceded nearly every major monetary transition in modern history. And patterns, once they start repeating across multiple assets at once, are much harder to dismiss as coincidence. That's exactly what's happening right now. Because this time, gold isn't moving alone. Silver has surged alongside it, breaking away from its usual role as gold's quieter, more industrial cousin. And Bitcoin, an asset built on code, not central bank promises, has started behaving less like a speculative trade and more like a hedge against the same fears driving investors into metal. Three assets, three completely different natures, one shared signal. If you've been with us since yesterday's episode, welcome back. And if this is your first time here, hit subscribe now, because this channel is where these patterns get connected before the headlines catch up. To understand why this convergence matters, you have to understand what these three assets almost never agree on. Gold represents ancient trust, thousands of years of use as money outside anyone's control. Silver carries a dual identity, half monetary metal, half industrial input, exposed to both fear and factory demand. Bitcoin represents something entirely different, a 21st century experiment in scarcity, with no central bank behind it at all. For all three to move together, something has to be pulling on a lever that all of them respond to. That lever is confidence specifically, confidence in the value of paper currency itself. And when that confidence starts cracking, it doesn't crack quietly in one place. It shows up simultaneously across every asset built to survive currency stress. Quick reminder. Before we go further, drop a comment telling us where in the world you're watching from. It's genuinely one of the best parts of building this channel, seeing how far these stories travel. So what exactly triggered this synchronized move? Was it a single data release, a central bank statement, a geopolitical spark? Or is it something slower and more structural, the kind of shift that doesn't announce itself with a headline, but instead builds pressure for months before the market finally reacts all at once? That's where this story goes next. Because the signal isn't just that these three assets are rising together. It's what their timing reveals about what large institutions may already be positioning for, and why retail investors are usually the last to notice. Let's start with the timing, because timing is what makes this signal impossible to ignore. This convergence didn't happen gradually over a calm, uneventful stretch of the market. It happened during a window when bond yields were sending mixed signals, when currency markets were unusually volatile. That kind of environment doesn't normally produce clean, simultaneous rallies across three unrelated asset classes. Normally, gold and Bitcoin barely correlate at all. Gold is the oldest store of value on the planet, moved by institutional reserve managers thinking in decades. Bitcoin is barely a teenager by comparison, historically driven by speculative flows, retail sentiment, and short-term risk appetite. Silver adds another layer to this story, because silver rarely leads. Historically, silver follows gold's momentum with a lag, amplifying the move once it's already underway rather than sparking it. This time, silver is moved with unusual speed relative to gold, at points even outpacing it. That kind of behavior often shows up when industrial demand and monetary fear are rising. Together, a combination that doesn't occur often, and one that tends to draw attention from traders who track the gold-silver ratio closely. If you're finding this breakdown useful, this is exactly the kind of connection we dig into every episode. So if you haven't already, now's a good moment to hit that subscribe button. Now here's where the story gets more interesting, because central banks are not bystanders in this. Over the past several years, monetary authorities in multiple countries have been steadily increasing their gold reserves, not as a short-term trade, but as a long-horizon strategic decision. That kind of institutional buying doesn't respond to daily headlines. It reflects a slower, more deliberate repositioning, one built around concerns that stretch far beyond next quarter's inflation print. At the same time, something unusual has been happening in crypto markets. Large holders, the wallets institutions and analysts often watch closely, have been accumulating Bitcoin rather than distributing it, even as prices climbed. That's a notable departure from typical speculative cycles, where big holders often sell into strength rather than add to it. When accumulation continues even as prices rise, it can suggest conviction in a longer-term thesis rather than a short-term trade. So what's the thesis connecting all of this? It comes back to something we touched on yesterday, the growing tension between government debt levels and the interest rates required to keep inflation under control. When that tension reaches a breaking point, policymakers eventually face a choice they'd rather avoid: tolerate higher inflation for longer, or risk economic pain severe enough to threaten financial stability. Markets don't wait for that decision to be announced. They start pricing in the possibility well in advance, and that repricing tends to show up first in the assets least dependent on any single government's promises. Gold, silver, and Bitcoin all share that one characteristic, even though almost nothing else about them is alike. Before we go further, if this kind of analysis is resonating with you, drop a like and share it with someone who still thinks these three assets have nothing in common, because that assumption is exactly what's being tested right now. There's still a critical piece missing from this picture, though, because knowing that these assets are moving together doesn't tell us what specifically triggered this particular moment, or how far institutions believe this trend could realistically go. That's where we're headed next, into the specific pressures building beneath the surface right now, and what history suggests happens when gold, silver, and Bitcoin all start telling the same story at once. To understand where this trend might be heading, it helps to look at what's building beneath the surface right now, starting with the bond market. Long-term government yields have been unusually volatile, swinging in ways that suggest investors aren't just uncertain about the next inflation report. They're increasingly uncertain about whether current debt trajectories are sustainable at all. When bond markets start demanding higher yields simply to compensate for that uncertainty, it raises borrowing costs for everyone, which in turn puts more pressure on the very governments already struggling under existing debt loads. That's the kind of feedback loop that doesn't resolve itself quietly. It either eases through difficult fiscal decisions, or it continues building until markets force the issue directly through currency pressure or credit concerns. Layered on top of that is a currency dynamic worth watching closely. Several major economies have been experiencing periods of unusual currency weakness relative to their historical norms, even in cases where their central banks maintained relatively firm policy stances. That disconnect matters, because it suggests currency markets are pricing in something beyond interest rate differentials alone, something closer to a broader reassessment of long-term monetary credibility. And historically, whenever confidence in a major currency comes into question, gold and other alternative stores of value tend to benefit disproportionately. If you've made it this far, that tells me you actually care about understanding these systems, rather than just chasing headlines, so take a second, subscribe if you haven't, and let us know in the comments which country you're watching from. Geopolitics adds another dimension to this story that's easy to underestimate. Trade relationships are shifting, supply chains are being restructured, and several nations have made clear they want less dependence on any single dominant financial system for their reserves and settlements. That kind of structural realignment doesn't happen overnight, and it doesn't show up cleanly in a single data point, but it shows up gradually in reserve composition, in bilateral trade agreements, bypassing traditional currency channels, and in the steady accumulation of assets that don't rely on any one country's cooperation to retain their value. Bitcoin fits into this conversation in a way that would have seemed unlikely just a few years ago. What began as a speculative, retail-driven asset has increasingly attracted attention from institutions looking for a scarce, apolitical store of value that operates entirely outside traditional banking rails. That doesn't mean Bitcoin has become identical to gold in function or behavior. It remains far more volatile, and its history is too short to carry the same weight as thousands of years of monetary use. But the fact that serious capital now treats it as part of the same conversation as gold and silver says something about how quickly perceptions of safety are evolving. Here's the uncomfortable question this all leads to. If institutions with the longest time horizons and the deepest research resources are simultaneously increasing exposure to gold, allowing silver to run harder than usual, and quietly accumulating Bitcoin rather than distributing it, what exactly do they believe is coming that hasn't fully reached public awareness yet? History suggests an answer, even if it's not a comfortable one. Major shifts in the monetary system rarely announce themselves in advance. They build quietly, reflected first in the behavior of assets that don't depend on any single government's promises long before that shift becomes obvious to the broader public. That doesn't mean collapse is imminent, and it doesn't mean every rally continues in a straight line. Markets correct, consolidate, and test conviction constantly. But the underlying message is harder to dismiss now than it was even a year ago, that confidence in the current monetary order is being quietly reassessed by the very institutions least likely to act on impulse. Whether this moment marks the early stage of a larger structural shift, or simply another cycle in a long history of gold, silver, and now Bitcoin reacting to uncertainty, one thing is clear. The signal is no longer subtle, and it's no longer coming from just one asset. If this documentary helped you see these connections more clearly, That's exactly what this channel exists to do. So, like this video, share it with someone still on the sidelines, and drop a comment with where you're watching from, because seeing how far these ideas travel is one of the best parts of building something like this. The real question now isn't whether gold, silver, and Bitcoin are sending a warning. It's whether the rest of the market will recognize it in time, or whether, like so many shifts before it, this one will only become obvious in hindsight.